Welcome back to Wealth Signal. I'm Alex Carter, and today I want to show you something that most investors are doing completely backwards right now. Let me ask you something. What do you do when a stock is up 880%? Do you hold forever? Do you take a little off the table? Or do you just keep adding more, hoping it never stops? Most people freeze. They don't know the answer, and that's exactly the mistake. Right now, the market is rewarding the stocks everyone is already talking about. Semiconductors, AI plays, the big, flashy names. And everyone is piling in, chasing performance that already happened. Meanwhile, a different set of companies with real revenue growth, real user growth, real cash flow, have been quietly getting crushed. Down 30%, 40%, even more from their highs. And nobody wants to touch them. That's where I'm looking. And today I want to walk you through exactly what I'm doing, what I'm trimming, why I'm trimming it, and the 3 names I'm watching as replacements. Before we get into it, if you're serious about building real wealth, hit that subscribe button and tap the bell. We drop new analysis every single day. You do not want to miss what's coming. So here's the situation. 2 positions I've held for a long time have done incredibly well. Micron, the semiconductor memory company, a gain of roughly 880% at the peak. Think about what that means. Every dollar you put in became almost $9. That is not a trade. That is a life-changing investment. And AMD, also a massive winner, up over 100% from the lows. Now here's the question nobody wants to answer honestly. At what point does a gain become a reason to rethink your position, not because the business is bad, but because the price already reflects the good news? There's a simple principle here. The market rewards you not just for being right, but for being right early. Micron was right and early. HBM memory demand, the AI infrastructure build-out, the scarcity of high-bandwidth memory, all of that played out exactly as the thesis suggested. That's why the stock gave you 880%. But here's what changes now. Micron is no longer a hidden gem. The market knows. Every analyst knows. The easy money, the money you make because you saw something others didn't, that money has already been made. So taking some profits here isn't panic. It's discipline. Now, where does that capital go? You have 2 choices. You can sit in cash and wait. Or you can rotate into something where the thesis is still early, where the market hasn't priced in the full picture yet, and where the price is giving you an entry that the fundamentals justify. That is exactly what we're going to talk about now. 3 companies, 3 different stories, same underlying logic. The business is growing, the stock is down, and the combination of those 2 facts is exactly the kind of setup long-term investors look for. Let's start with Axon Enterprise, ticker AXON. Most people hear this name and think, tasers, the company that makes those electroshock devices for police. And yes, that's how they started. But calling Axon a taser company in 2026 is like calling Amazon a bookstore. You're missing the entire picture. Axon today is a public safety operating system, body cameras, in-car dash cams, digital evidence storage, dispatch software, AI tools that analyze footage in real time, and all of it tied together in a cloud platform that every police department, every corrections facility, every federal agency is now being pushed to adopt. This isn't optional equipment anymore. This is infrastructure. Now let's talk numbers, because the business story is compelling, but you always need the data to back it up. Axon's revenue over the last 12 months hit just under $3 billion. Their most recent quarter, Q1 2026, came in at $807 million in revenue. That beat analyst expectations. Connected devices revenue is growing over 30% year over year. Their software and services segment, which is the high-margin piece, is also growing at a similar pace. Future contracted bookings have climbed to over $14 billion. That means the revenue isn't a guess. A huge chunk of it is already locked in, and the customer retention rate? Sitting above 120%. That number means existing customers are spending more every year, not just renewing, expanding. Now here's the honest part, because balance is everything. Axon is not cheap. The market cap sits around $36 billion. The stock hit an all-time high of nearly $880 in August of last year, and it has since pulled back sharply, now trading around $390 to $450, depending on the day. That is a significant decline from the peak. Is it cheap? No. The valuation still demands growth. You are paying for what this company can become, not just what it is today. But here's the thing. The business is growing. The moat is real. Switching costs for law enforcement technology are enormous. And the pullback from near $880 to the $400 range means you're looking at a company that is less expensive, not cheap, but meaningfully more attractive than it was at the highs. That's the entry point thesis. Not a bargain, a better price on a great business. Quick question before we move on. Are you currently holding any public safety or defense technology stocks? Drop it in the comments. I read every single one. Stock number 2 is Reddit. Ticker RDDT. I know what a lot of you are thinking. Reddit, the forum website? That's not an investment thesis, that's a meme. Stay with me, because the data here will change how you see this company. Reddit is one of the few platforms on the internet where authentic human conversation actually happens at scale. Not bots, not polished brand content. Real people, real opinions, real discussions, across hundreds of thousands of communities covering every topic imaginable. And in a world where AI companies are desperately hungry for human-generated data to train their models, Reddit is sitting on one of the most valuable data assets on the planet. Let's look at the numbers, because Reddit just posted one of the strongest quarters I've seen from a growth company this size. Q1 2026. Revenue came in at $663 million. That is 69% growth year over year. Not 20%, not 30%, 69%. Gross margin is sitting at 91.5%. Think about what that means. For every dollar of revenue, 91 cents stays in the business after direct costs. That is extraordinary efficiency. Adjusted EBITDA margin hit 40%. Operating cash flow, $312 million, up 145% year over year. Daily active users reached 126.8 million, growing 17% year over year. And the advertising revenue, the core business, grew 74%. The average revenue per user is climbing fast. More users, spending more per user, on a platform with basically no cost of goods. That combination is rare. Now the honest part. Reddit has real risks. A significant portion of their web traffic comes through Google search. If Google tweaks its algorithm, and Google does tweak its algorithm, Reddit's traffic can take a hit overnight. That's a concentration risk you need to understand going in. And Meta just launched a competing product targeting Reddit's core communities. Whether it catches on or not, competition from a trillion-dollar company is always a headwind. But here is what I keep coming back to. The stock is currently trading around $175. It hit over $300 last year. That is a significant pullback on a company that is still growing revenue at 69%. The market is pricing in fear, not fundamentals. I'm not saying load up. I'm saying the risk-reward here is more interesting than it was 12 months ago. Stock number 3, Shopify. Ticker SHOP. If you've been anywhere near financial content in the last 5 years, you know Shopify, the e-commerce platform, the thing that lets anyone build an online store without needing a software engineer or a warehouse. But the version of Shopify in 2026 is not the version you were thinking about in 2020. This company has quietly transformed into something much harder to compete with. They're inside ChatGPT. They're inside Microsoft Copilot. They're inside Google. Merchants selling through Shopify can now reach customers through AI assistants from one single system. No other commerce platform has that. Harley Finkelstein, Shopify's president, called it simply, "Shopify has entered the AI era with a clear edge. 2 decades of commerce intelligence that nobody else can replicate overnight." The numbers back that up. Q1 2026, revenue hit $3.17 billion. That's 34% growth year over year. Gross merchandise volume, the total dollar value of sales flowing through Shopify, crossed $100 billion in a single quarter for the very first time. And it didn't just cross it. It came in at $100.7 billion, up 35% from a year ago. Merchant solutions, payments, lending, capital grew 39%. Subscription revenue grew 21%. Free cash flow came in at $476 million for the quarter with a 15% margin. Customer acquisition cost, payback, 5.3 months. 5.3 months, meaning the company gets its money back on every new merchant in under 6 months. And then that merchant stays for years. Now the risk, because there always is one. Shopify's stock has pulled back hard, from a 52-week high of over $182 down to around $119 today. The market didn't like something in the guidance: rising transaction losses, some concern about macro pressure on consumer spending, elevated operating expenses. And here is the honest truth. At $119, Shopify is still not cheap. It is less expensive than it was at $182, but you are still paying a meaningful premium for future growth. The case for Shopify is not a valuation case. It's a business quality case. This is one of the most competitively positioned companies in global commerce. And the AI integration they're building, selling through ChatGPT and Copilot, is something no competitor can match right now. When a great business gets cheaper, you pay attention, even if it's still not cheap. So let me bring this together. 3 names, 3 different stories. Here is how I rank them personally, and this is based on my own analysis. Your situation may be completely different. Number 1, Axon. This is my top pick of the 3, not because the valuation is the most attractive. It isn't, but because it has something rare, a real moat, a product that is very difficult to switch away from once adopted, a business that operates in a sector where government spending continues regardless of economic cycles, and a growth profile that shows no signs of slowing. Number 2, Shopify. The business quality here is exceptional. The AI integrations are a genuine competitive edge that will compound over time. The risk is valuation. You're not getting a deep discount. But you are getting access to one of the best commerce platforms in the world at a price that is meaningfully lower than it was 6 months ago. Number 3, Reddit. Highest growth rate of the 3. Most asymmetric risk-reward, but also the most uncertain path. The Google dependency is real. The meta competition is real. If you believe the AI data licensing story plays out, and I think it will, then Reddit's long-term picture gets very interesting, but it requires the most patience. Here's the bigger lesson behind all of this. The market has a very short attention span. When something is going up, everyone wants more of it. When something is going down, even if the business is fine, nobody wants to touch it. That asymmetry is where long-term investors make their money, not by chasing what's already won, but by identifying businesses where the story hasn't been priced in yet and having the patience to wait. Rotation isn't retreat. Taking profits on a 880% winner and redeploying into businesses growing at 30, 34, 69% with less of the crowd in them is not giving up. It's thinking ahead. This content is for educational purposes only. This is not financial advice. Always do your own research before making any investment decision. If this breakdown gave you something to think about, do 3 things. Hit the like button. It takes 2 seconds and it helps this channel reach more people. Subscribe if you haven't already, and leave me a comment. Which of these 3 names interests you most? Axon, Reddit, or Shopify? I want to hear your thinking. I'm Alex Carter, and I'll see you in the next one.